Hello everyone, welcome back to my channel. So today is August the 1st, or Saturday, and today we are sitting at a loss of almost 104,000 euros, which equates to a little bit over, let's see, 103,772. So it's about 119,780 18 or $19 on a rounding basis, and this is where we stand. This was a very unstable week. We have a lot to unpack here, but let's start first with our economic data. For the time being, things continue relatively unchanged. If we look here at the price of gold, gold had a somewhat negative week. It continues to be not that far from the $4,000 support, and it had pretty much a seesawing profile here after it was coming down under the expectation that maybe the Fed would raise interest rates by Wednesday night, but it ended up not being the case. They held up, and so there was a rebound. There was also another rebound on Thursday, on the basis of what happened over here, in which GDP data came out, and also the PCE, which is a favorable inflation measure for the Fed, and this came, as you can see here, on a year-to-year basis on the headline. It came as expected, but less than the previous month. And here on a monthly basis, on a core, it came a bit softer than also expected, and when it comes to year on year, it came as expected. So all in all, given the expectations, this was a rather positive development, all right? But then, for me at least, this was a little bit more important because it showed that the Q2 GDP slowed down considerably and even came below what was expected. It was expected an 1.8 growth year on year, and ended up being 1.5. So I have to say that the Fed's role, or the Fed situation at this meeting, was a little bit sensitive, or sensitive, it's probably the better word, because they did not have access to this data when they made the decision, and the decision that came out, which was keep interest rates where they are, was met with some skepticism by the investors, because they feel that the Fed is lacking, or is loosening its grip on reining in inflation. And so this data appears to have vindicated a bit the Fed's decision. Also, of course, keeping in mind that inflation data came a little bit softer. The CPI and the PPI came also softer for the month of June, all right? And this confirmed that maybe, from the perspective of the Fed, this was the best decision. However, we know what has been going on in the markets over the month of July, and so you know that oil has been appreciating strongly, and is on a much higher level than it was now than it was at the end of June. And so August is going to be a month in which, for sure, inflation is going to come back roaring, and so we will see. But coming back to the gold, this was the situation. So gold appreciated on Thursday on the back of this data, but then on Friday, because there was quite large appreciation, it pulled back again. Silver followed more or less the same profile. It did not even came close this time of the apparent support that it has on the $55 level, but it stayed pretty much here, always bouncing off the 57, and it followed basically the same behavior as gold did, expectedly so, because they are quite correlated in terms of their price moves. And oil, even though it came down along with gold and silver, which is, as you know, over the past couple of months, has been quite an unusual pattern. Usually they go in opposite ways, but this time, until the end of Wednesday, they follow the same pattern. But crude oil has also the situation of the war to be correlated with. So that's the reason why probably this happened. But then it came back because the apparent progresses in peace negotiations had a step back, and so oil came back again. It ended up being positive for the week. And if we look here on a monthly basis, what I was talking about is that at the end of June, price was at this level, and now over the month of July it came back very strongly. It pulled back, as you can see here, over the past week and a half, but still it's a very, very strong increase from around 66 to 86. This is more than $20, and so this is way more than the 20% increase. This is almost a third, yes, 33% increase for the month. And so I'm expecting that the inflation data for August is going to be quite bad, and that will probably be the reason why, if you look here at the Fed funds futures, you'll see that there's about a 2/3 probability pricing in for a 25 basis point increase on the Fed's interest rate for the next meeting, which will be on September the 16th. And so this is my expectation. I don't agree with this interest rate increase if it happens. I may record a short video about why I think this is wrong. This is the wrong decision. The right decision would be to keep rates as they are. But this is something that I will consider doing. But coming back to the economic data, also we're going to start next week with the data for July for the data for July for the jobs market, and this may also give us a better idea of where we stand in terms of the economy, because the economy only grew 1.5% during Q2. This will be another pulse rate taken on the jobs market and on the economy as general, and then this will be also a very strong input for the Fed to understand whether it should keep rates as they are or if they should increase them. And for us that we are holding these metals positions, of course, it's for us it would be better that the jobs report would come badly and would strongly underachieve the expectations. You can see here that there's an expectations for a strong jobs market report, because the previous data point was June with 57,000 jobs created. We are not considering any revisions at this point, which may always happen, but at this time the expectation is that 85,000 jobs were created. So the expectation is that the job market improved, more jobs were created. So if expectations are anything to go by, we can expect that the jobs market will continue to improve, and this will be bad for our metals positions, because this will give more leeway for the Fed to increase rates in September. But this is what's going to happen for next week, for the week that's going to start on Monday. But then one of the biggest asset tests for the month is going to be the following week, but we'll get to that later, which when CPI and PPI will be released, and I'm quite sure that this is not going to come good. You can see here that this data is going to come only in about 2 weeks, so we have of course more time to go over it. But going back here to our positions, and this is of course is our European account, we were not able to make any progress. We keep the same positions as before. Of course, we collected premium, but this is not our focus at the moment. We sold some puts. We sold also the calls that I showed in the previous video. We rolled over this put on GDX for the next week because it became apparent that we would not reach this strike price, and so I rolled over for the next week. And now, given the situation that we are facing for August, in which I believe it's going to be a bad month for metals because of the increased inflation due to oil increases, I'm not going to be any more flexible on the strike prices that I will choose. I'm going to select quite conservative ones because if my expectations are correct, in which it's going to be a bad month for metals, we want to stretch as much as possible our strike prices and go as far below as we can, because they may be exercised. And so that's why I'm foreseeing that in the case of GDX we may go even below 71. It would be a big fall, but still, given what lay ahead, I think it's going to be a possibility. For the GDX, if we end up selling some puts on this, I'm going to be very tempted to go at around the 91 range. We sold on our Emirati account, I'm going to show it later, but we sold a put on 75.5. Given the situation that's going to have this month, probably will go below that, so we'll see. And for the SILG, because we are rather close of getting rid of this, because our cost base is currently for these 1,000 shares is $26. I'm gonna double down on this, but I'm going to again use the same strikes as we did this week. I'm going to use again the 23 strike price. I'm also going to use the 23.5 strike price because if the both strikes are reached, we're going to be able to bring our cost bases, of course using the same amount of puts that we did, we're going to be able to bring our cost bases to around 25. And this point, I think we can be fairly sure that in the short term, on a rebound, we will be able to get rid of these shares. Now, when it comes to the SLV, of course, there's nothing we can do. The position is so large, we can hardly move the needle on the cost basis at this point. So we are going to leave this for last, because there's nothing we can do here except waiting for a recovery. But the one that is closest to be sold is the SILG. So this is the one we are going to put most of our chips, so to speak, and the GDX, because we only have overall across the two accounts 600 shares. So this is something that we can also move the needle quite easily, or relatively easily. So we're going to put a bigger focus on this, see what we can do, and then with the buying power that we may get from selling these positions, double down on the GDX, on the IAU, before we contend with the SLV. And so far, this is where we are. We have for the next week 14,000 and almost 700 euros to deploy, and yeah, we'll see what's going to happen. Let's move and to our Emirati account and see what went on over there. All right, so here we are In the meantime, over the course of this week, I made a 10,000 dirham deposit in addition to the 25,000 dirhams I already deposited on Monday, and these additional 10,000 dirhams were used to sell a put on the SILJ, which is here. But as you saw, likewise, what happened with our European account, these $23 puts expire worthless, so nothing really happened here. Like we did in our European account, we also had a put here on the GDX, which we sold with our 25 dirhams that we deposit, and we rolled over for next week because it was there for the taking, even though it was only still Thursday, but we already been able to buy it back for 2 cents, having received in this case 30 cents, so this is a pretty good deal. And then we sold it back for next week for 39 cents more. Of course, because then became also clear that the price would not be achieved. This position now is trading at a loss, but it doesn't really matter because we would rather have it assigned and lower our cost basis, which, by the way, as we stand, if these two puts that we have across both accounts, if these two puts are assigned, we will get our cost basis down from 85.50 to 81.88. So we will be able to come down from our 86 calls to 82 calls, which is a quite significant step down, and it's going to be extremely beneficial for us. In terms of the GDX, we did nothing. We just left the position stay where it is. Although with this fall that happened this week, and this is something that I did not mention when I showed our European account. You can see the extreme volatility that took place over this week, but still it's down for the week, and this may be a factor that makes us go over there and also sell a put on it. But at the time we only have about $10,000 in buying power over here, so this may not be all this buying power would be consumed simply by one put of GDX, and it would not leave us any room for anything else. So maybe this will not be the way to go for next week. We'll maybe sell the same things that we sold last week, so another put on the SILG and another put on the IAU, the gold trust index, the gold trust ETF, but we'll see. Of course, we are now also at a loss here because of the fall down of these positions, but this is a fall for the that happened on the day. On the in general, in this account, we are still with a gain of about a little bit less than 300, but I'm not counting this over our grand total because it's a gain, it doesn't really matter, and this is resulting from this is a result that came after, so it doesn't really matter at this point. So this is where we stand, and feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions, and as always, feel free to like the video and subscribe to the channel, and we'll reconvene next week to see how the trades played out, and of course to brace ourselves and hang on to dear life for the month that lay ahead of us. And I'll see you there.